Last week was fairly bloody in the markets. However, for the company under the spotlight today, UnitedHealth, they were one of the few that were up, but very marginally, around 1.5%. And this is one company that continues to be in the spotlight. If you remember, a few weeks ago, they reported their earnings, which in fact was an EPS miss, and then they went on to cut their guidance, something the market didn't like to see. We then saw some very strange things happen to the company where the CEO left abruptly, although we were told this was for personal reasons. On top of that, for a forecast that was just recently cut, they ended up fully suspending their full year 2025 guidance. And for those that are interested, the new CEO will be getting a very sizable $61 million pay package, and he's also one that was in fact a CEO for around 8 years in the company, one that many investors do believe helped with very large returns to shareholders. But as we said, the sentiment is very bad for this company overall. It was just weeks ago where the Wall Street Journal released an article saying that the company was under criminal investigation by the DOJ for possible Medicare fraud. However, this was shot down very rapidly by the company, where they said they have not been notified by the DOJ and that ultimately the Wall Street Journal's reporting is very irresponsible. Now, the bad news did not stop there at all. The share price continued to drop as it was released that they've been secretly paying nurses to reduce hospital transfers, and that whistleblowers who did come forward said that they were also told to allegedly harm their residents. Again, this is not a great look for a company that just continues to be in the spotlight, but also you could argue for a very valid reason if all of this is to be believed. And to make matters worse, we get more articles coming out really pushing this negative sentiment. We have Vice, where they've said United's health plan to cut their costs is just to let the elderly die. And finally, they've also now been accused of pressuring medical staff to change their patient status to do not resuscitate. And whilst they do try to tease which insurance company this is, I'm sure the large part of people would have gone on to guess UnitedHealth. With that, analysts have continued to cut their price targets for the company. We're talking about the same analyst making many cuts in just a matter of days, and we can see here Jefferies have lowered it to $400, although ultimately they do still see this company as a buy. We then have another analyst, Wolf Research, bringing this down to $390, although ultimately they do see this outperforming the overall markets. And just last week we got a very large cut that is from HSBC, and they ultimately see this as a $270 stock. Given the share price as of today, this is in fact some notable downside. Now, you may be thinking there's a lot of negative news about the company, perhaps the regulatory issues as well as some of the larger concerns should really put you off adding this company. Well, we have some individuals who actually believe now is the best time to consider a position, and that is members of Congress. As we can see here, from March to May the 21st, 9 different members of Congress have been adding this company, as we can see here, on 18 different occasions. And some people who are now believing that Marjorie Taylor Greene is the new Nancy Pelosi, given her close ties to Donald Trump, definitely one to keep an eye on, has also been adding, as we can in fact see the date around the time the company did plunge. But again, this company, for the reasons we have mentioned, has continued to be on a bit of a downward spiral. Now, worth flagging, the overall market is starting to turn green. Many companies are now looking fairly positive, but UNH, the one we're covering today, has suffered a massive drop that is down 42% in 2025 alone. And if we look at the company overall, it is trading near their 52-week low. However, we still get a double buy from both Seeking Alpha as well as Wall Street. And as we can highlight, not just down year to date, but also over the last 12 months, negative 43%. We're going to compare their performance against the S&P as well, but pretty much it isn't that far off the S&P's movement over the last 10 years. Without including dividends reinvested, you would be up 146%. So is this company still an undervalued buy? Many analysts have been cutting. Their guidance, in fact, has completely been suspended. We're going to talk about our updated valuation in the episode, as well as talking a little bit about the underlying metrics of UnitedHealth. Do also factor in, when we get to our margin of safety, there are a lot of things that we have previously covered that we will need to incorporate, but solely on a focus on the valuation, trading at a forward P of 12.7, that is massively below the 5-year average of 20.2, massive disparity, one of the lowest, if not the lowest forward P on offer to shareholders in such a long time. This is one severe undervaluation signal, but important to remind you that we never use valuation as the ultimate focus for our own additions in the portfolio. The same to be said on the dividend yield, 2.84%, one of the highest on offer, well above the 5-year rolling of 1.42, so severe undervaluation all the way around. And that is also confirmed when we take a look at this model. The blue tunnel does signal the expected fair price. However, we have to point out it has been decreasing just in a matter of months. Given we have noted the forecast suspended, they missed on their earnings per share, many factors to incorporate, but this tells us, given the disparity, even on the drop of the blue tunnel, where the company sits today and that lower end, that is again severe undervaluation. Remember, we will also put it through our own valuation model so you can see where we have got to our own overall outcome. Now on the valuation, they do get a C-, forward PE sitting at 13. This highlights to us that the sector is trading at a fairly large premium, sitting at 17.2. In fact, we can see here UNH is trading at a 25% discount, but as we just mentioned, also trading at a discount to their own historicals. So UNH pretty much across the majority of valuation metrics today, whether you look against the sector or you look against their own historicals, the company does trade at quite a significant discount. Important to understand though, some companies actually deserve to be trading at a discount, and therefore we should apply that when coming to our own valuation. We want to understand, one, does it deserve a discount, or is this an incredible opportunity that the market has mispriced? And two, what sort of value should we be placing on the intrinsic price? Both things that we will get to in the episode. Now, we really want to highlight that the market overall is sitting in greed, where typically we'd like to add companies in extreme fear. Remember Liberation Day, low single digits. But what this ultimately reflects is that when we look at valuations across the S&P, many are deep into the red, meaning overvalued or potential overvaluation. Again, never look at valuation in pure isolation, but ultimately not just UNH, but also those that are sitting in the healthcare plan industry could provide a lot of opportunity, whereas other sectors may now not be one to consider. Again, one aspect we do like to incorporate. And if we do just look at their latest earnings, as we said, EPS was below what analysts were targeting. Revenue was up 10% year on year, and they also had some nice efficiencies to their bottom line net profit margin, up 7 percentage points. Now, over the next 4 quarters, they only anticipate one of them to be growth, and they do have a 75% track record, 3 out of 4 beats, with the most recent quarter being a fairly sizable miss. And for those that like to look to the next full accounting period based on the EPS estimate, but again this was cut, so this was on what they originally anticipated, the company is trading at a forward P sitting around 11.1. Again, this is something that can change depending on what they release in the upcoming quarters, but as of now, forward P around the 11 mark. Now, institutions do hold quite a lot in terms of ownership at 88%. We see 36 billion worth of sales over the last year. During the same time frame though, we do see a lot more buying, so they're definitely more bullish than bearish. That is also something mirrored when we look at the most recent quarter. 19 billion worth of shares bought, 9 billion worth of shares sold. So not just bullish over the last year, but also in the most recent quarter. For example, if we wanted to go and see when does that trend reverse, you'd have to go to Q1 2024, where we see more selling than in fact buying. But as we said, 12 months and in the most recent quarter, institutions clearly more bullish than bearish. Now, if you did miss it, we also got some massive buys from insiders at the company. And remember, typically insider buying is seen as a bullish signal because it means they believe the share price will ultimately increase. And we can see here with 0.33% insider ownership, 2.5 million worth of selling over the last year, we get 32 million worth of buying, so a lot more buying than selling. Not only that, all of those buys have just come in the most recent quarter, and we can also take a look to see who those individuals were and how much they bought. Most recent, the 16th of May, we got the chief financial officer buying over 17,000 shares, costing them $5 million. And then we also note the CEO on the same day buying over 86,000 shares, costing them, as we can see here, $25 million. Also, as we discussed, US Congress member was also buying, so lots of bullish signals, but as always, do your own due diligence, never rely on insiders, institutions, and even super investors. And speaking of super investors, when we take a look at their own portfolio, we can see 17 of them in fact hold UNH within theirs. And if we look in fact at the most recent activity, so quarter 1 of 2025, Nothing really to point out here given the minimal change to their overall portfolio composition. We can see though one in fact did reduce by around 2.8% and they trimmed 81% from their overall portfolio. We got another one that was a new position in their own portfolio, but again, very trivial. Information though is here if you do want to incorporate it in your overall thesis. Now looking at the growth, and this will help us alongside profitability shortly to understand if it does deserve a discount to the overall sector. Year on year, 8% growth, moving forward around 9%, marginally above the sector at 6.5% and 8% respectively, but lower than their 5-year average around the 9 to 10% mark. EPS expected to grow around 7% over the next 3 to 5 years. That is below both sector at 10 and their own 5-year at 13. So you could argue perhaps a small discount isn't something that does look to be strange for UnitedHealth. And then if we look at the profitability, they actually get an A+. Gross margin 22%. Sector does sit higher at 60, as well as their own 5-year at 24.5. Bottom line, 5.4%, actually a lot better than the sector that is negative, meaning they're burning through cash, and also not far off their own 5-year average of 5.6. When we take a look at cash they generate from operations, 28.5 billion, well above not just their own 5-year at 24.5, but also again the sector which is burning through cash, negative 11 million. So in essence, you could argue this company perhaps deserves a very small discount, or actually it deserves to be roughly in line with the sector. But then again, the sector as a whole, as we just pointed out, is burning through cash. So perhaps you're on the side that actually this company does deserve to be trading at a premium, one that we would perhaps also agree. Now, just for a quick recap, we get a double buy from Seeking Alpha in Wall Street, a C- on valuation, F on growth with an A+ on profitability. And now let's take a quick look at some of their underlying metrics. First thing we will point out though is their dividend safety score did get downgraded. It now does, however, still sit in the safe region 80. We uncovered these two severe undervaluation signals, and they did in fact increase their dividend last June by around 12%. Meaning we are anticipating over the next few weeks to get another increase. And as we just said, it was downgraded during the time when a lot of these issues were present, but still a safe score is meaning a dividend cut does look to be unlikely for UNH. Now, some key metrics from how they performed in the last 07-09 recession: they maintained the dividend, didn't increase, didn't in fact cut, plus 5% recession sales, well above the average of the S&P, which was negative 12, and they did trail the S&P, although marginally, negative 63, the S&P itself, negative 55. Now, this company has historically been a very attractive dividend growth company. As we can see here, over the last 10 years, on average, they've been increasing those dividends 19.3% year on year, whilst also increasing it consecutively for the last 15 years and paying a dividend for the last 32 without a reduction. Now, it makes sense how they can offer those very large dividend increases given their free cash flow payout is consistently below 60%, sitting at 31 on a trailing 12 month and anticipated to go a little bit lower over the next year. So hopefully in the coming month we do get a very nice, again, double-digit increase. Free cash flow per share, consistent growth over the longer term. Whilst we did get a dip from 23 to 24, it is anticipated to continue the upward trend over the next 12 months. And sales growth looking very good. Many years we're seeing double-digit increases. Most recent one sitting at 8%. And we can see from the below on a numerical basis, they have increased their top line revenue more than 2 times over the last 10 years. In terms of shares outstanding, obviously we also love it when companies return excess cash to shareholder pockets, not just through dividend increases, but also share buyback programs. We can see they have been buying some, although not that much over the last 10 years. Our thought is perhaps we could see a nice share buyback program authorized if management believe now the share price has fallen over 40% that it is looking severely undervalued. ROIC, we want to see 10% or more to give us faith management are able to effectively allocate their capital. We get to see that on a very continuous basis, 14% in fact in 2024. Investors and prospective investors will love to see that. And whilst we see the operating margin not quite above our 12% preference, as we noted against the sector overall, their profitability does score very strongly, so no real issues, at least for the time being. And the same to be said, free cash flow margin straddling around that minimum 5% we want to see on a year-on-year basis. Now, net debt to EBITDA, very important, highlighting both dividend safety and balance sheet strength. We want to see below 3 for the majority of companies, and the numbers you see below are the number of years it would take them to pay off all of their debt net of cash on hand. 1.2 on a trailing 12 month, expected to go up a little bit over the next year, so definitely something to keep an eye on, but overall balance sheet strength does look good, as well as their dividend safety, although we did note a very small downgrade. We also want to see how has the company performed against others in the sector. Is it just an issue with this healthcare company, or are we also seeing some effects from the sector wide? And what we do notice over the last year, this company is down 42%, but actually every single one, bar one, is down. So not only does UNH have some problems in isolation, but we can also see the sector as a whole is just not performing that good at all. In terms of flipping it to over the last 5 years, they're up only 8%. That is very, very poor. But again, the majority in this whole sector haven't given really returns that maybe an investor would like to see. And over the last 10 years, again, the same is to be said, although a lot of their drop has just come from the last few weeks. Without that, they would be sitting in number one place and a very massive disparity against even second place. So lots of things to bear in mind, but as we can see, not the greatest performance overall. Likewise, when we do compare it against the S&P, they're down 42%, the S&P is up 10%, so they have massively underperformed. The same to be said when we look over the last 5 years. Whilst it is now positive, it is up only 8%, with the S&P up nearly 100%. And over the last 10 years, you can see that massive drop, so now it is only marginally outperforming, up 187%, the S&P up 175%. Question is, do you have that conviction it can continue to outperform, although it has only now sat in that marginal outperformance, or is it worth considering a low-cost ETF like VO that does just track the S&P 500? Now, before we jump into our own valuation, always good to look at a company's income statement and balance sheet. Starting off with the income statement, they have grown their top line revenue, as we said, very strongly, more than double, 157 billion 10 years ago to now sitting at 401. But what we really want to identify is, what does the bottom line net income tell us? Is it a similar story? Are we getting a fairly consistent performance between both top line and bottom line? And the answer for the large part is yes, going from 6 billion 10 years ago to now sitting at 14.4. And whilst we have got the drop from the previous year, based on the trailing 12 month, it does look like the upward trajectory will continue into 2025. These are things you should always consider when analyzing companies. And then we move on to a very quick health check, total cash versus total debt. We see the cash has been increasing over the last 10 years, going from 11 billion, nearly tripled, to 31 billion. But as always, balance sheet, don't look at any numbers here in pure isolation. They won't give anything away. So we compare it to their total debt numerically and directionally, and we can see, similar to their cash position, it has been increasing, nearly tripled, going from 32 billion 10 years ago to now sitting at 81. So definitely something to be aware of. As we saw, the net debt to EBITDA is climbing, although only slightly, does still sit below 1.5, but as always, something to note on a quarter by quarter and year on year basis, so make sure you are subscribed as we do continually update our analysis. Now, just before we jump into our valuation, we want to let you know we have released our latest free weekly article. We draw on every single Monday morning, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now we jump into our updated intrinsic value, which comes to $440, purely the average of the four that you see on screen. Now we're going to run through each one, the inputs and the outputs, starting off with Graham's valuation, where we have the EPS, we have the growth rate, AAA corporate bond yield, giving an intrinsic price of $286, our first overvaluation signal, although bear in mind, not far off the market price, and as well, we never look at one of these models in pure isolation. We then have the multiples valuation model, companies in a similar sector and size, the average PE multiplied by the EPS of UNH, giving us another overvalue signal, but again, it isn't that far off the market price, so 2 overvaluation signals so far. Then we have the dividend discount model, very nice increases, on average around 14% for the period. We've gone a lot more conservative at 6.5, where we get our first undervaluation signal. We then move on to the DCF model, free cash flow year on year, average growth 14. We've gone a lot more conservative at 6, Incorporating the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 593, our second undervaluation score. So the intrinsic value, 440, average of the 4, 2 undervaluations, 2 overvaluations. And remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for UnitedHealth or any others. Now, we're not just done there, because we always like to use a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $396, then we keep going till it's near the current trading price. And in essence, what we're saying is quite a sizable MOS today, 35%, around $286. Not quite there yet, not far off. So we're saying around 30 to 35% for UnitedHealth. Wall Street themselves see this at $382 over the next year, translating to 30% upside. So give us your thoughts. UnitedHealth, we have seen Wall Street lower their average forecast to 382, but still 30 to 35% margin of safety, 30% upside. Is this one you're considering? Maybe one you continue to buy the dip, or for whatever reason this doesn't fit your overall portfolio. Give us your thoughts below whether you see this as a buy, hold or sell. And don't forget, as always, to sign up to the free weekly newsletter. We are dropping a fresh copy today. Grab those spreadsheets, come and join us in the Patreon where we cover our buyers and sells. And as always, have a great day. We'll see you all on the next one.